Today, we're diving into a topic that's on everyone's mind, the housing market. Specifically, we're going to explore the 18-year property cycle and ask the big question. Are we heading for a boom or a crash? A recent report from Rightmove showed that property prices fell by 1.2% in July, and they have cut their annual forecast for price growth to just 2%. This drop is being attributed to the end of stamp duty cuts, and more homes being for sale now than at any point in the last 10 years. This leads us to the central debate. Is the 18-year property cycle a reliable indicator, or have recent unprecedented events finally broken its long-standing pattern? Economist Fred Harrison famously and correctly predicted the 1989 and 2008 crashes years in advance using the 18-year property cycle. He believes the next crash will happen in 2027, not 2025. For those new to his theory, go to gradragstoriches.co.uk, where we have 6 posts dedicated to this. So, where are we now? The pessimists point to 4 key factors that they believe are driving an impending crash: a weak economy with potential job cuts, small landlords and second homeowners selling up due to rising taxes, a general rise in household costs like council tax and energy bills, and a looming fiscal crisis that could force the Bank of England to hike interest rates. But there are also strong counter-arguments to each of these points. Wage growth has been good recently, improving affordability. Private and institutional investors are increasingly buying up rental properties, which could absorb some of the supply from small landlords. And while household costs are up, there are new government supports and easier access to mortgages that could cushion the impact on demand. Speaking of mortgages, market forecasts are pointing to 2 interest rate cuts later this year, which would be good news for the housing market. Recent years have presented a barrage of challenges that critics argue have fundamentally altered the 18-year cycle. The COVID-19 pandemic, ongoing global conflicts, and a period of higher interest rates have all caused significant market volatility. Some critics even point to the fact that, when adjusted for inflation, the average house price hasn't really grown since 2012. On the other hand, a huge piece of financial news just broke this month. Chancellor Rachel Reeves is planning to allow banks to offer mortgages up to 6 times a borrower's salary. For a couple on a combined £80,000, this means their borrowing power could jump from £360,000 to £480,000. This move rings some serious alarm bells. It doesn't take an economic genius to know that if you lend people more money, house prices will rise. Yet stretching mortgage debt this far increases the risk of financial overextension for borrowers, potentially contributing to a future crash. So, is the 18-year property cycle broken? Despite all the conflicting signals, Fred Harrison's confident that the long-term fundamentals haven't been erased. He believes the market is emerging from a correction phase and is entering a recovery phase, soon to be followed by a boom. Harrison forecasts a significant rise in prices before a major crash around 2027. He sees recent dips as a necessary recalibration and anticipates falling mortgage rates will stimulate further market activity, especially in high-yield areas like Leeds and Sheffield. This perspective is bolstered by news like lenders being allowed to offer higher mortgages and substantial investment flowing into the build-to-rent sector, all of which could fuel a potential boom. So what do you think? Are we on the brink of a new property boom, or is a crash just around the corner?